All right, what's up, traders? Welcome back to the channel. Let's go ahead and get this thing started, shall we? I got quite a bit of stuff to discuss today, so we're going to get this thing going real quick and we're going to try to keep it rolling. Let's go ahead and talk about the S&P 500 real quick. If you notice over here on the S&P 500 where the green line is, you can see that we are expecting an 82 point, or you can round that up to 83 point expected move for this week. Now, that is very, very strange if you consider that we do have a Fed meeting on January the 29th. January the 29th will be Wednesday of next week. That's crazy that the market's only expecting an 83-point move out of that. They're obviously not expecting the Fed to do anything, as there is just a 97.9% chance that it stays the same right now. But if you put that into perspective, an 83-point move next week puts it at around 16.5 or 16.5 points every single day. That's like a 17-point move on a daily basis. Now that can be construed as bullish, right? The way it works is the less volatility you have, generally the markets will slowly melt up. And that's actually what I expect, but I expect a lot more volatility than just 83 points. Last week we had a trend line, and when we came into that trend line, we gapped up well above it and then retested it as support and then took off to the upside, making a fresh all-time high and a fresh high day close on Thursday. So a lot of shorts were stuck right there, obviously. So now we know this move right here was just a normal correction, just a pullback. We ultimately filled this massive election day gap. Classic bear trap. Are we making a bull trap now? That could be argued, but before we get into that, your expected range high for next week on the cash market, ticker symbol SPX. The expected weekly range high, 61.84. The expected weekly range low, 60.18, 6018. And that's the entire move expected for next week. So here we have the VIX. We did, in that last bout of volatility, when we did fill that election day gap, we had a daily gap up above the resistance of $20.20. If you remember any of my videos in the past, that was a major resistance level that I said if we start closing dailies on the VIX above that point, then obviously I would be more bearish. But we did not close a single day above it. Even though we did gap well above it, that whole entire day you traded down, and the VIX has been melting off ever since. I believe your run higher on the VIX is over. All right, so moving on to Bitcoin. What do we have? Well, the one thing most every entertainer is going to be talking about as far as Bitcoin is concerned for this week is you do have or will have a weekly divergence. You need a weekly close. You need a higher weekly close than this close in order to make divergence. RSIs are calculated for the close. So a swing high or a wick high is not enough to constitute bearish divergence. You need a higher weekly close. But anyways, all you got to say is if you close where we are right now or higher, you will be printing bearish divergence on the weekly time frame, and that is a pretty good sell signal. I don't have the numbers right offhand, but you can look it up yourself, go test how many times it worked and whatnot. I'd say it's probably around 40% of the time. That's just a rough estimate. Now we do have bearish divergence here on the S&P 500. Something important to take away from what the S&P did last week is huge. If I was going to be shorting weekly divergence, like if I was going to run with that signal, for instance, say I wanted to short it based on that signal, I would have wanted to see a rejection here at the 60. All right. It doesn't matter if we wick up above, set a fresh all-time high. I would have wanted to see this weekly close back down and put this signal or this RSI back under the 60. Now, is it possible that closing above the 60 is making a bull trap? Yeah, that's possible. But what is more probable? The more probable scenario is you got a fresh high day close, you have a fresh high week close, you have a fresh all-time high, and you have a fresh buy signal, or you had a fresh buy signal last week when you closed at the 60 with a strong weekly close, and we've seen bullish continuation from last week's signal. Unless the majority of this week was sell side positioning, I do not see this bearish divergence signal playing out. It looks more bullish than bearish. I just wanted you to know that there is weekly divergence on both of these assets. All right, or you do have it now on the S&P, and Bitcoin's weekly doesn't look as strong as the S&P. This will close tomorrow at 7 p.m. Eastern Standard Time, and where we are when that happens, then that might give me more of a broader look, because Bitcoin is the most risky asset in all of risk assets. It is the riskiest. So if Bitcoin is showing a weak weekly close, then maybe that is hinting at a potential short on the S&Ps. Only time will tell. But for right now, everything still looks pretty good. This weekly candle still looks good. You're testing the midpoint right now as we speak. Is this an area to potentially get long? It could be. I am already long. I got long on Thursday. This trend line right here is just a near-term daily trend line from this wick low. It's pretty much done a good job of encapsulating those lows there. We're in a 10-week range. We just made fresh all-time highs this week. I would like to see it close above last week's high. That would be, nice and look stronger. But here's the thing. I generally want to see the first couple days of the week being bearish, so that way I can look to potentially buy on Tuesday, the weekly low. Time will tell if we get a bearish move going into next week first, or if we get a bullish move. We don't know what's going to happen right now. If we look at this stuff over here, let me go into the liquidation heat map model number 3. You can see that there is quite a bit of liquidity under near-term price all the way down into the 90s. I believe there's liquidity, sufficient sell-side liquidity all the way down to $92,000. Also have sufficient buy liquidity, or your short stops, to push you up to 117,000. Liquidity has been building up in this long-term range. So you can look for moves up to as high as 117 and down as low as 92. That is a massive range, and you can catch really good trades anywhere in there. And you can see that it's pretty much like what it shows on the liquidation heat map, right? You got more liquidity situated down to 92,000 on the sell side than you do on the buy side. You're more than likely not going to do a big run higher and then reverse and do a big run lower. I mean, if it does that, that's fine. But the problem is by the time price makes its way up to 117,000, all of this stuff in here, that's dark zone, will be filled in. That could potentially push it even higher. So this isn't a really great thing to look at. It is on the near term, but at the same time, it's just an indicator. My longer term bias based on price and price alone is up. Anytime we get it back above the 21 exponential moving average, I have to be bullish. And if you look at this right here, I mean, this thing has been steadily holding the 60 on the daily. That is more of a bullish signal than a bearish signal. So right here in the near term, it is why I am positioned more bullish than bearish based on just this price chart alone. It's enough data to say, yeah, I want to look to be a buyer on daily lows or on weekly lows. Weekly lows would be better. Like if you could catch next week's low, that would be a much better trade to look long there than instead of getting long here, right now, today. That's the way you need to approach next week. Look to be a buyer on the lows. Buying a weekly low isn't always going to work. Of course it isn't. You're going to get stopped out. Ultimately, being long on the weekly lows has been a better trade than looking to get short the weekly highs. But to be fair, Bitcoin is so volatile, it has such big ranges, you can be long and short in the same day sometimes. All right, but anyways, longer term signal looks good. You're above the 60 on the weekly. That is a bullish signal. And on the daily, you're holding the 60 pretty consistently here. You're making higher highs and higher lows. You have an ascending trend line. You're in a 10-week range, but the range is, as of right now, holding good and looking good for a pretty good size run to the upside. So I am position long. I will hold that long. As of right now, I'm long. Long and strong. So we did talk about the VIX. It's lower. It looks good lower. Let's also talk about something else. Skew. Skew is important. I think it used to be more important than it is now, and I'll explain why. Usually when you have a high skew like this, it does mean that you are seeing a lot more out of the money puts being bought. That's what the skew is showing us. If we go look at an options chain briefly, I have the S&P 500 pulled up here, 30 days out. If we go down and we look at the implied volatility, which is here, if we look at the out of the money call implied volatility, you can see we're at 9.47%. All right, 9.47%. If we go look at the implied volatility on the put side, you're going to see that we are at a 14.79%. So that's where you're seeing that skew come into play. So a lot more people are buying out of the money puts than people are buying out of the money calls. Now, this is nothing more than a sentiment indicator. Nothing different than, say, your fear and greed index or any other sentiment indicators. It just says that the sentiment right now is bearish. That's what that means. But if you think about it, a long time ago, maybe 10, maybe even 15 years ago, this would have been much better to look at because there are a lot more retail traders out there nowadays than there ever has been before. Way more. And most retail traders have small accounts. If they have small accounts, what can they do with that? Well, they can make bets, out of the money calls or out of the money puts. So you have a lot more retail traders trying to pick tops and buying out of the money puts. Now, you still do have a lot of big firms also buying out of the money puts, but those trades that they're putting on isn't a sentiment trade, it's a hedge trade. That's the difference. A hedge trade doesn't necessarily mean they believe the market's going lower. They're just trying to hedge out downside risk. And they will do that when the VIX gets cheap, because when the VIX gets cheaper, the put options get cheaper. The cheaper the VIX gets, the cheaper the puts get, the more puts start getting bought. But if you add up all the new retail traders that are just straight up making only one side trades, bets that the market's going to roll over, they're going to lose money most of the time, because the market, as we know, thanks to passive investing, most of the time goes up. To literally be betting on a massive decline in the markets right now, you're going against the grain. You do not have many indicators showing you that you should be bearish. So if you have a bearish bias right now, I think you're on the wrong side of the markets. If you think that I am wrong, tell me down in the comments section. Let me know. Am I wrong or am I right? Let me know. I have been thinking the dollar's going to pull back for a few weeks now. We're getting that pullback. I have a long position on the Aussie dollar. I literally posted that on Twitter. Right here, Aussie dollar gave us another shot at getting long this morning. Here it is. This is my current position. I am holding that open still. If you look at this daily candle right here, and then go look at the actual Aussie dollar chart, this is that wick low on that daily time frame. That is where my long position is sitting. So I am long. That means I am short the dollar. Now, the reason I chose the Aussie instead of the euro was simple. We were above the 2025 yearly opening range already on Aussie dollar. We did the analysis in the weekly live stream that I do for my Patreon members. That live stream is every Sunday at 11 a.m. Eastern Standard Time. And every one of those live streams are recorded and they stay inside of the Discord. They're on the YouTube channel and they're on Patreon. So if you are a member on YouTube or a member on Patreon, you get those videos. We were looking to buy the Aussie because the Aussie was above the yearly opening range at that point in time. So on that Sunday when I made the video, this was the weekly this was the daily candle that we had. All this happened on that Monday. So going into that week, we wanted to do do the Aussie instead, because here's Friday, we were above the yearly opening range. So that's why we were looking at the Aussie instead of the euro. But the euro has moved up slightly more than the Aussie as far as in pips. So the euro USD long was a better long. If we just look at, say, this wick low right here to where we closed Friday, you can see that we're about 151 pips higher. We go look at the Aussie, we're at 105 pips. So you do have 50 pips more on the euro than you did on the Aussie. But how am I supposed to know that's going to happen, right? My trade ideas are based on the data that I have going into the week. I can't make predictions on which one's going to have a bigger move. I just knew that going into the week, I wanted to be short the dollar. And I did that by getting long the Aussie. And I made that very, very public for everybody right here before the trade even happened. This was on Jan 20. Jan 21, Jan 20. Why I liked Aussie dollar for a short trade instead of the euro. The Aussie is above and has already retested yearly opening range. That's it. But if you would have noticed this, right, and you wanted to trade it, you would have had a chance to get long the very next day, which is when I put on the position. I have a short bias on the dollar, long bias on Bitcoin, long bias on the S&Ps, but I will be hedging going on moving forward and looking for intraday scalps to the downside potentially as well. But my overall bias is higher. Now, and finally, we'll go look at ratios. Everything looks good still. I mean, this looks good. Let's just look at the weekly instead, right? Growth versus value, that's bullish. And that's what we want. We want to see growth outperforming value always. It's when value starts outperforming growth that we have to be a little bit more cautious. Here's your XLK versus energy. Obviously, energy had a big move. However, you can see this move lower versus the XLK was right in line with every other high it made. Essentially, all you did is made another higher low, just like you've been doing since this thing has been bullish, right? Since 2020, the end of 2022 going into 2023. And that's when we got bullish, and we're still bullish. So we've been bullish since the beginning of 2023. And most of these things are and have been bullish as well. This is the SPY versus your XLP defensive sector. Does not look defensive at all. XLE versus SPY. This is supposed to trend lower. That's what we want to see. So we want to see the SPY winning. It is winning. This thing is making lower highs and lower lows. That is perfect. And here is the SPY versus the dollar. Beautiful. With the dollar sell-off, we can see this thing is getting a fresh breakdown, which could indicate we're going to see lower highs and lower lows continue as time moves on. Everything looks good. So if you are looking for bearish entries, I advise you to be taking profits quickly on those lower swings, because you're more than likely going to be stopped out. I think you would be better off if you were looking to buy swing lows. Still, we've been right for 2 solid years. I mean, just in the bullish aspect of since I've had a public channel. I usually don't want to brag and stuff like that because everybody else does. But I mean, we've been consistently right on all major market shifts. For people not to be long right now, you are literally going against everything. You should have been long for the last 2 years. Since January 2023, you should have been bullish. If you missed all of it, there is no reason for you to get bearish now. Please listen to me. If you are thinking you need to be short because you missed all of this run, you are doing it wrong. Thank you guys for being here. Make sure you smash the like. Make sure you guys trade safe, trade smart. And as always, happy trading, everybody.